All right. Okay, so this being our first debut on the webinar, today's talk is only about half an hour. So it's only about half an hour. So in that case, let me just get right down to it into the so-called presentation. The main purpose here is to invite candidates. For all of you, should be presumably CFA candidates, preparing you for your exam. And I know that your exam has been postponed. Good or bad news to some of you. But anyway, what am I going to do is I'm just going to have a half an hour session. And then after that, I'm going to open for a 15 minutes Q&A. So during this session, please feel free to look up at the top panel, and then you see a Q&A, and then you can ask any questions, which I hope I can answer. I can answer straight away. Yeah. All right. So that will be the format for today. Okay. So I'm sure, as you would know, that this year has been tremendously very, very memorable. I'm sure most of you will not forget this day. Come. Let me just look into the screen. I'm sure you can see the screen. All right, number one is that for your CFA exam curriculum journey, for all the 3 levels, you would have gone through 15 readings. Altogether, there'll be 15 readings for you with regards to fixed income topic. I chose this topic because there are some quite very notable things that are happening right now globally, as well as in Malaysia as well. Okay, so as you would know, your CFA exam comprises of 3 levels, and all these 3 levels, though they cover the main topic called fixed income or any other topic for the same, but each level has their own emphasis. Well, in CFA level 1, you were, the CFA exam is open to all candidates from all walks of life, so therefore one cannot assume that one has the prerequisite knowledge. So therefore, the first reading in CFA level 1 is basically a dictionary, a hand-holding part introducing you to all the products and services in the world of fixed income. So level 1 is very much product knowledge, to know what are bonds, what is asset, what is ABS, what is CMO, what is government bonds, what are agency bonds, securitization, callable, puttable, option embedded bonds, and so on. So as you go through your CFA level 1, you essentially go through broadly all about all broadly about your products, issuances, and so on. Yeah? Then a little bit about valuation, a very, very simple valuation approach into it. Then once again, then you introduce into asset-backed securities and a bit more about credit risk. Now, CFA level 2, so CFA level 1 is about analysis. CFA level 2 is about your valuation. No? So it's basically how to value. It's all about valuation. It's about how do you fair value option embedded bonds? How do you fair value your convertible bonds? How do you fair value, well, all kinds of bonds that we have in the market? Securitization, for example, covered bonds and so on. Huh? Okay, so therefore, level 2 is very much left brain because it's mostly about your valuation methodology. Level 3, on the other hand, is primarily for your level 3 is primarily for the fund manager. So therefore, it's fixed income for the fund manager. Fixed income for the fund manager. I see some of you were raising your hands. If you need me to slow down or send me a message, do use the chat function. I'll try to read the chat more often so that I can understand. Yes, no, Sharina said whether the slides will be sent. Yes, I will send all these slides to all of you later. Yeah, sure, no problem. So there's nothing to copy then. Right. Okay, so CFA level 3 is about, for the fund manager, is about asset allocation. So today's webinar is about guiding through what you learn in your curriculum and how you react to today's environment. And then we'll see how this seminar can be where you apply what you have covered in your curriculum to basically what's happening right now. Okay, let's move along. Now, so this is again your CFA level 1 curriculum, introduce you to all kinds of bonds, and through history, legacy, we have government to be the biggest issuer and the original issuer of bonds. So we have primarily treasury bonds, TIPS, and so on. Then we have agency bonds, quasi-government bonds. We also have your corporate bonds, or sometimes your credit papers, as they call it. And usually we divide them into investment grade. And in today's terminology, we also have high yield, which is, of course, non-investment grade. Okay, so let's level 1 introduce you to a broad range of bonds in the market. Even though there's a wide variety of bonds in the market, investors do prefer plain vanilla. So plain vanilla bonds tends to be the default setting. But of course, from time to time, we do have seasonality. I mean, 1994 was the year of the inverse floater. And now, of course, we can see that the trend right now is perpetual sukuk or sukuk musyarakah, which we do find that quite a good number of our construction companies are coming to town issuing bonds as well, from WCT, SP Setia, and the latest one, LBS Bina as well. Yeah. Okay. Well, fantastic year. I think this year is the conference of the Black Swans, and we already have 4 convergence issues, as you would know. We in Malaysia, of course, it started globally. Of course, it started in November, December last year in Wuhan, and it spread over after Chinese New Year. We have the COVID-19 global pandemic at the moment. Then in Malaysia, our politicians decided to introduce more stories for us to tell. Then Federal Reserve cut interest rate, looking into this particular scenario. And for in the first time in the history, the entire yield curve dropped below 1%. First time ever. So things to remember by for this year. And of course, we do have the oil price shock, where Saudi and Russia could not agree, and therefore all these 4 things coming together create a very memorable event, as many of us would know, and the share market reacted big time together with the bond market as well. Right, and so triple whammy in Malaysia: political drama, COVID-19, oil price shock, and we can find that globally speaking, the yield curve has jumped through the roof, and it was tremendously very, very significant into the past. Now, in fact, but of course, we just consider very quickly. Now, I'm just going to run through some of these basic slides for it. And so right now in Malaysia, the yield, of course, government have received a little bit of a spike in the yield. I mean, just about 1-2 weeks ago, you'll find that all these yields were below 3%, 2.8, and of course, there were quite a bit of a sell down over the last 2 weeks, as you can find. Now, things that are happening here brings back my memory. Brings back memory to the days where perhaps some of you were not even born yet. The days to what we call the ASEAN financial crisis. So just a bit of background to what has happened way back about nearly 23 years ago, and that was essentially. I mean, this year is, I mean, to the Chinese zodiac, this is the year of the rat, but two rats ago, in the year 1998 was then the year of the rat, where we have your ASEAN financial crisis to begin with. And what happens here, of course, in this period, as you would know, I mean, for perhaps this is now old timers telling old story. Well, what happens here about that 23 years ago was, of course, that there was a trade war. There was a trade war between Japan and US, because Japan economy was rising and Japan was their automobile was penetrating through the industry space in the US with their Toyota and their Honda, and the Japanese yen was accused. Japan was accused to artificially manipulate the yen currency to make it undervalued. And so therefore there was a bit of a trade war going on. And then yen rose suddenly, triggered a reverse carry trade. And you can find one by one, the entire so-called the region collapsed. And during that period, of course, we do have the base lending rate. Let me just look for where I got the base lending rate. And during the period observed, the base lending rate in Malaysia went to as high as about 11 to 13%. At one time, just at one point in time, Clibor hit about 14%. Clibor hit about 14%. So we do find that this was a period of difficulty, and the US dollar unprecedented. Now for us, when I was young, US dollar used to be known to be at 2.5. So 2.5 was the so-called the rate that we know US dollar. $1 buys 2.5 ringgit. And that was like for the longest time. We'll find relative stability during this period. And then of course, during the ASEAN financial crisis, the dollar begins to spike upwards. We begin to find that, that the ringgit deteriorated to a historic high, or even touching to about 4.5, numbers that we are looking at today. Okay, so, and of course, Malaysia then had a capital control, which is 1998. So 1998 was a period where Malaysia imposed capital control, and that, of course, brought the interest rate down. So the interest rate was brought down. So day one after the capital control, which is on the 1st of September 1998, you'll find the interest rate begins to drop. Now, so during this backdrop, so during the backdrop of the ASEAN financial crisis, banks were failing, interest rates shot up through the roof to double digit, the ringgit collapsed to unprecedented historic low, to even 4.5 at a certain period in time. That was possibly what we know as the darkest moment in the Malaysian history. And I hope that remains the darkest and not this year, the year 2020. Okay, now, and during this period, of course, we do see the emergence of the Malaysian corporate bond, Malaysian corporate bond. Okay, let's come back to the PowerPoint slides as we now move along. Let me just come back to the slide. Yeah? Right, and for the last Monday, we will see that we look into the year 2009. Right? In the year 2009, relatively, the Feds were cutting interest rates. Right? The Feds were cutting interest rates. 2009. And 2009 was pretty much a very good economic year for the performance year for the US as well. So you find like bonds like Tesla, for example, 5.3 coupon Tesla, 15 August 2025 date, you'll find that the Tesla bonds would have gone through quite a substantial margin. So I mean, here if you look into the screen, you'll find that the bond performance ranging from the start of 85 right down to about 102. Bond prices hit the roof. And of course, last Monday, you'll find that overnight, the bond just experienced an extremely sharp trend like that. Such trend was never seen since the ASEAN financial crisis. That was about 23 years ago. This kind of trend was not observed. And it's not just about Tesla. Okay, even though Elon Musk has some issues with the regulators, we're also looking into Prudential, for example. We'll find that bonds were relatively trading at a premium, and within just a moment of 3 to 4 days, the bond price drastically dropped from about 105 all the way to about 86. And likewise, of course, we have here Hewlett-Packard. Hewlett-Packard, 6.35% bonds, maturity about 25 years to go, 15th of October, and we'll find that bond prices dropped to as low as about 85%. So this was quite a global phenomenon. Ringgit bonds, due to its relatively illiquidity and non-tradable status, we do find that we can say that our Malaysian ringgit bonds were more or less relatively unaffected, save for the MGS over the last 2 weeks here as well. All right, and of course, as you can see that the spread is not tremendously, very, very wide. So we're referring to the bid and ask. So the bid and ask spread has quite a wide widened itself, and therefore does create now a lull of illiquidity in the market. Illiquidity. Right. So these are now the current phenomena that we have seen over the last 2 weeks, all in the bond market itself. And again, we'll find that the Federal Reserve initiated a sudden cut in interest rates down to about 50 bips. And that was just about coming up to just about last week. So you'll find that that over the period of 2019, interest rates were on the way down. And the previous year, of course, it was just on the way up 2 years ago. Okay, then of course, we'll see that the Federal Reserve is looking into providing cheaper financing and boosts. Now, of course, in the theory of your textbook, CFA level 1, level 2, the textbook supplies that when the interest rate comes down, bond price goes up. Therefore, this will be basically this is bond behavior 101. That a very common knowledge. And of course, for bond investors, this will be one of the key rules to apply. Interest rate comes down, bond price goes up. And so in the year 2009, 2019. In the year 2019, when Federal Reserve cut interest rate, or the year was about interest rate coming down, then of course we'll consider that we can have looked into the earlier three bonds, that bond prices rose. Hewlett Packard increased. You'll find that Prudential increased, and you do of course find that Tesla would have increased as well. And likewise, of course, if we do remember from our concept that the relative price increase has got to do with duration. Price has to do with duration. So changes in price is your negative modified duration times changes in interest rate. And therefore, as interest rate decline, bond price would increase. And having a bond with a long maturity of about 23, later we'll calculate the duration, then we'll see how you can see that the bond price would have increased as well. Yeah. And of course, the COVID-19 has more or less also put a stall in the current issuer. So in a primary market space, we see fewer issues coming in. And of course, for the case of US, the cutting of interest rate, pumping liquidity, they still won't be able to address the sudden demand in the interest rate as well. Okay, so this will be the first part where we look into just the general phenomena. Is everybody with me? Right, huh? Okay, so let's say for example, I'll come to a little bit more, because today's topic is about aligning the so-called CFA curriculum into what's currently happening for the time being. Let me bring myself back to Hewlett Packard. Now, one of the manifestations of trading in the bond market, of course, as many of us would know, is that bond prices tends to converge at par. There's a convergence at par. That is, of course, the key consideration is unless there's a credit event. So unless there's a credit event. And so generally, well, let me just take a look into, let me just go to the whiteboard. Sorry. Now, generally, as you know, the one thing that separates between equity trading and bond trading, we do find that the similar pattern was observed over the last 2 weeks. So therefore, you can find that during a period of or what we call tail event, if you may want, during a tail event, or basically a non-steady state, during a non-steady state market environment or a tail event, we do see the phenomena called correlation spike. And so during this period of correlation spike, we'll find the convergence of prices. Even Bitcoin, gold to a certain degree, followed the same path as equity and bond. Basically, it just applies to the entire spectrum of capital markets. And one part of the reason that later justified this is also margin call. Because in most cases where trades are leveraged and when prices of one drop, if let's say the investors were on margin here, and to address the margin call in the event that the equity price would fall, they might trigger the sale of the bond market because they would then need liquidity to finance or to pick up their margin. Therefore, margin trade tends to also contribute to the correlation spike all across the market because of the immediate need for liquidity. So therefore, the liquidity issue comes in. So this is where you have your equity and bond. Okay, but apart from that, of course, if you look into the equity market, and then we can consider what is the outlook. Now, what is your outlook? In the outlook for the equity market, of course, we do have people who subscribe to fundamental analysis for the longer run. So looking at fundamental valuation, contrarian play will come in, contrarian value investors will not be pretty much excited. We may have technical analysis looking into a shorter term period, or even some dare say that the share market manifests random walk. The prices are random walk. But in the bond market, of course, we do find that bond prices behavior can mirror or equate to the equity performance, especially on the high yield. But the one thing about the bond market, of course, is, I mean, if you look at the Hewlett-Packard, for example, the question to ask, what will the Hewlett-Packard share price be 5 months from now? What will Hewlett-Packard be 1 year from now? And the consideration of the valuation for Hewlett-Packard with respect to the current COVID-19. Okay, we can find that, of course, the level of volatility is still high, and the level of uncertainty may not be crystal clear to the investor. But for the case of the bond investor, such level of volatility and uncertainty would also prevail. However, of course, in the bond market, one would see that unless default, the prediction is that the bond price will be par. On the 15th of October 2045. And therefore, this is a part whereby bond prices tends to manifest a convergence effect. Usually for bond traders, the concept of support and resistance line for long-term bonds is what we call the 80-120 rule. The 80-120 rule. Bond prices very seldom see below 80, and one seldom goes above 120. But of course, this is not really psychological limits, but it's more mathematical than psychological. As you look into this level itself. And so indicating that for bond trading, when prices drop near 80, there is always this tremendous opportunity to relook and to reassess the outlook for the bond, because for the price certainty will be that there is a convergence to par in a held to maturity amortized manner. To look at it. Okay, so coming back to this part, we now come into the CFA level 3 curriculum. In CFA level 3 curriculum, let me just now. So in CFA level 3 curriculum, we now look into fixed income for the investor. Okay. Sorry, I forgot one thing. Sorry, I beg your pardon. Now, coming back to Hewlett-Packard. Okay, in coming back to Hewlett-Packard, one consider that if you look at it from the beginning of the year, or even right down to year on year about March last year, we'll find that bond prices were hovering up 104. So prices were 104. And by the end of the year, prices were nearly about 120. Prices were nearly about 120. And therefore that registered a price change of about 15.4%. A 15.4% change. Now, if we were to put things into perspective, in CFA level 1 and level 2, what we did for the curriculum is to appreciate why do bond prices increase, as more so when this is a credit paper, this is a credit bond. Therefore, there will be, of course, an element of credit in it as well, and also the outlook for the company's performance. But generally, to a very large degree, the price appreciation of about 15.4% price from 104 to 120 for Hewlett-Packard will be driven primarily for the changes in interest rate. For especially this bond is 6.35% coupon, 6.35% coupon. Okay. All right. Well, so what's going to happen? So let me just move along to my Excel screen. Let's say, for example, okay, so now, of course, in your CFA exam, your CFA exam is not Excel based, be grateful for it. You just have to bring a calculator. But of course, Excel has excellent computation. Settlement date normally is where we put today. Today is our settlement date. And maturity date for the Hewlett Packard bond was 15 October 2045. And its coupon is 6.35%. And let's say par is 100. And what is the yield? That's the thing. What is the yield? But to look into the yield, of course, we can reverse engineer what is the price today. And the price today, as you can see, is 91.04. And just about 2 days ago, it was actually 85. No? So therefore, this is quite a very volatile period for time being. So 91.04, so you can see that the price is 91.04. And so the price is 91.04. And so therefore here, what CFA level 1 bond mathematics would suggest that, of course, you should use your financial calculator, is that if you were to buy this bond today, or if you are able to get this bond price today at 91.04, and you were to commit to hold it until it matures, then your yield to maturity, your yield, of course, will be your settlement date to your maturity date to your rate, coupon rate, your price, your redemption, and bonds are often semi-annual, as more often than not. And therefore, this would be where by just capturing this bond, we can see that the yield to maturity would then be about 7.12%. 7.12%. So 7.12% for Hewlett Packard. For Hewlett Packard bond, it was a yield that was shocking. Right? It was shocking. But just about 2 weeks ago, when the price was about 130, when Hewlett Packard was near 130, the yield was about 4.39. So 4.39 compared to the fact that Federal Reserve just slashed interest rate by 50 points, and that the yield curve will remain predictably low for possibly the next 5 years. And this would be a telltale sign that once the dust settles, this bond will begin to look very attractive, especially when you're looking into 91.04 for the time being, 91.44. So the bond price yield will be about 7.12. And to find 7.12 into, but of course, bear in mind that Hewlett Packard can be classified as a high yield bond, or it can be classified as a credit paper. So it does carry itself an element of risk. And of course, for Malaysians who consider investing, there is always the understanding that this is a dollar bond, and dollar at the moment is hovering at 4.4. And possibly by the time the investor is ready to exit from this investment, we might be looking to a currency possibly stabilizing down at about 4.1, but just anyone's guess. But now, since I'm here, let's take a look into the modified duration. The modified duration. So the modified duration, again, you can also use your financial calculator to calculate, but allow me to just very quickly come up to here. So, and again, using financial calculator, you can find that the modified duration for this bond would be then about 11.6, 11.6. And so as you would know from your CFA level 1, and also necessary to calculate in your CFA level 2, and also 3 to a certain degree when you use it, is there's no convexity, sorry, no such thing for Excel. Okay, so anyway, as you would know, for every 1% change in interest rate, the bond price will change about 11.6%, 11.6%. And so Hewlett Packard has experienced a double-digit change in price just about last 2 weeks ago. All right, so this will be just looking into yield calculation, duration, which of course very essential in those pursuing your CFA level 1, CFA level 1, the ability to calculate duration. And Now, as we now bring ourselves to CFA level 3. Now, CFA level 3 looks into the asset classes, especially fixed income, in the perspective of the fund manager. And so here, the first question to us, from an insti investor, the first question to us, all institution investor is, do you have a liability structure? Do you have a liability structure? So therefore, that's the question. Do you have a liability structure? That would be the first question to ponder. Now, for institutional investors, the pension funds, insurance, banks, these are the typical insti investors that will say yes to this question. Yes, they do have a liability structure. And if they do, then the asset allocation of primary importance will then be ALM, asset liability management, or ALDI, liability driven investment, liability-driven investment. So therefore, either you do ALM or you do LDI. Now, ALM is ALM is more centric towards liability. That means the asset allocation will pay respect to the liability. Generally, classic cases like endowment, insurance, and pension funds. For their liabilities represent payout to beneficiaries. And therefore, they must have assets to match against it. And of course, LDI, on the other hand, maybe let's say give an example, PNB, Pembedalan Nasional Berhad, they have their products like ASB, and ASB is essentially fixed price unit trust, fixed price, some sort of concept of principal protected investments. And so when you have that kind of product feature, essentially that becomes your liability, because notwithstanding any investment, you should not drop below your par value. And therefore for PNB, even though PNB is technically a unit trust, one should consider it to be a no, but because of its product, it is essentially more of an LDI, liability-driven investments. All right, and so very simple. If the question is yes, then please execute or underperform your ALM or LDI. And to do so, of course, the three most common asset allocation strategies, primarily, of course, would be cash flow matching. Now, cash flow matching is more fantasy than practical. Cash flow matching is more theoretical than the ability to undertake, unless, of course, you have a single liability. But generally, for many insti investors, their time buckets will be laden with multiple timelines for liability. And now, of course, EPF may have to ready itself for 500 ringgit withdrawal for every beneficiary. All right? Thanks to government who generously help us by giving us our own money. And therefore, if the liability timeline is as such, then the asset should match exactly dollar for dollar. Therefore, in this perfect world assumption that the assets are allocated in such a manner their redemption will mirror on a ratio of 1:1 to the dollar of liability that is expected to be redeemed throughout the entire timeline. So that's cash flow matching. And as you know, academicians, theorists tends to start with something on a perfect world assumption before they then move to something more practical. And of course, the practical one is duration matching, And a more dumbed down version is then horizon matching, or horizon matching more closer to maturity matching, All right, therefore this will be for the insti investors. Their asset allocation will have to mirror the duration. Okay. And of course, for those whose answer is no, for those whose answer is no. Therefore, if no, you don't have a liability structure, then essentially yours is equity structure, unit trust, hedge funds, private equity. Then of course, you will then consider that your benchmark is not your liability structure. Then of course, it will have to be your, it will then of course have to be your investment. Okay, now let me just move on very quickly as time is running short. And so here as we consider that all across your active investment strategies, we have a whole wide array of strategies that you have in mind. Early on when I talk about horizon matching, maturity matching, they are essentially near to asset liability matching type of strategies. And of course, we do have right down to active bond trading and carry trade strategies that we also have. Okay, so along the line, we do consider that the bond investment variety offers an extremely wide spectrum of investment. Especially now as we consider, usually we will tend to divide that. These are basically meant for a more stable environment, or what we consider to be steady state. Usually investments like riding the yield curve. That means riding yield curve just means you buy longer term. You just buy longer termed investments and sell it to match your maturity. And so all these investments usually involve a more stable state investment. And for those which are non-steady or the more volatile state, so this where it opens opportunity for active bond trading and possibly a bit of a carry trade, especially when we look into a bit more of a currency. But of course, currency is a bit more volatile as well. All right. Okay, now, and just coming back to the last 2 weeks, we do find that for generally the wider spectrum of investment, has usually the first state of a crisis is correlation spike. I do have one question from Raj Kumar. Raj Kumar asked the question, does the correlation spike indicates that investors are moving towards keeping cash than to stay invested? I would say in one part, yes. That tremendously the need for liquidity is high during that period. And the correlation spike will tend not to last for very long. Within a short while, possibly now in a very interconnected world, it will take about 2 to 3 days. Then you'll find that investors will then move to the second stage where right now the cash, as you mentioned, it has such a tremendously low interest rate. The yield is so low, the investors will then tend to step up a bit. So what happens here, we can see that there is this, as usual, there will be, this is a classic of what we call we call this the flight to quality. So this is always the flight to quality cliche. And we consider the demand of late for this ETF, which is a very large volume, 21.4 billion, large volume, a 20-year treasury bond ETF. Therefore, for retail investors, for insti investors who would like to park their money in a more diversified US treasury bond, long-term, 20 years, we'll do find that this ETF itself tends to be an indicator, at least it reflects what has happened over the last 2 weeks. So after the correction spike, that would happen. And likewise, for the case of the high yield ETF, we saw Tesla just now, we saw Prudential, we saw Hewlett Packard. These are just 3 samples from the wider spectrum of bonds, and they almost all of them manifest very, very similar pattern over the last so-called since last month. We'll find that the tremendous decline in prices. Here you can see that the the prices are quite sharp, nearly hovering about 33 right down to 24. So this will be quite a significant margin. Maybe with European coming up with some stimulus package, and US, finally Congress, both sides have actually agreed for some $2 trillion packages coming out to be launched on this Friday. Possibly we might see that in the long run there will be a bit of a reversal trend. So this knee-jerk reaction towards high yield. But having said that, one has to remember that the US high yield, most of the US high yield, we do find that there's a very large portion of energy companies. Energy companies. So therefore, they are a bit to be taken because of the shale, because of the shale producer. And so this knee-jerk reaction is primarily, largely also affected by the energy issue, the oil price that has been affected. Now we look into EMD, emerging market, especially China. Emerging high yield, mostly construction company, mostly China-based construction company. Even in Malaysia, we also see that some of the recent high yields are also from the construction sector. Therefore, the high yield. So when you look into high yield, within countries, their compositions are quite different. So one has to be careful for that as well. All right, Catherine asked a question. Catherine asked a question that, yes, the last 2 weeks we saw Treasury yield drop below 1%. And then of course, the question is, does it mean even investors has no appetite to the bond market? Now, to answer this question, no appetite, we do find that even during the ASEAN financial, let me just bring back to the ASEAN financial crisis story, because I try to see there's a similar pattern between here. Now, so during the ASEAN financial crisis, well, you can say that the correlation spike means everything was very, very bad. And even our MGS, our Malaysian government bonds, dropped to nearly 80 to 90, dropped to 80 to 90 range. And then, of course, on the 1st of September. So this is when usually I will tell my student, you know what, if you have a time traveling machine, now actually, if you do have a time traveling machine, there's far more exciting thing to do than to buy bonds. But since today's topic is on bond, this is now time traveling advice for bond investors. You set your clock back to the 1st of September 1998, because that was the date Malaysia imposed capital control. And capital control brought one certainty to the interest rate environment. Interest rate environment will be cut down low. From a CLIBOR hike of 14% to about 4%, a 10% cut in interest rate within a period of 15 weeks. And we do find that the bond market staged a very fantastic rally, fantastic rally. And during that period in time as well, boutique asset management companies were mushrooming everywhere. Licensing was very lax. And so we find that bond dealers became multi-millionaires during the period. This was during a period of scriptless trading. It was tremendously a crazy period, and the bond market rallied. And so coming back to the question of Catherine, the initial part, yes. The knee-jerk reaction in any correlation spike is that bond prices fall all the same. But then bond prices has a tendency to revert, because once again, investors still needs to meet their cost of funds. I mean, we talk about insurance in London, we talk about banks, they do have their cost of funds. The companies have the WACC, we do have our base rate, and one cannot stay in government bonds for too long. Government bonds can't match the cost of funds for many of these insti investors. And so sooner or later, they will move up from government and they will tend to come back to the high yield bonds. So therefore, this is quite a very typical pattern that one can see as well. All right, Yang asked the question, how long does it usually take after the sharp drop for investors to return? Well, I would say that I would like to quote from empirical observations or data that uh, the reversion tends to be swifter for, definitely the reversion is manifest in your government bonds. That goes without fail. That you can see that during a period of crisis, that government bonds will tend to be the first one to experience a spike. But we do see that for high yield bonds, uh, the issue, of course, with the US, the issue with the US is that most of the US high yield bonds essentially are energy. Therefore, for fear of the crude oil, this may linger on longer. It may linger on longer. But for non-energy related companies, those that may be perceived to be consumer staple bonds or like Hewlett Packard manufacturing, mass production, manufacturer, we do find that bonds may experience a V shape. So we do find that there are many more commentary that a V shape look will be expected because naturally due to the crude oil shock that we saw last week, that shock triggered the general large-scale sale for the high-yield ETF. But then, of course, we'll find that some of the papers that are now the bottom-up approach in manager will begin to pick up the slack, so to speak. So some of the bonds might see some very sharp reversal as well. All right, we do have one person by the name of Hope. Hope says, why do investors keep on buying negative yielding bonds rather than, say, putting the monies in fixed deposit instead? Well, it's very hard to mention that. I would think that it is counterintuitive to, of course, buy negative yielding bonds, but rational investors will buy whatever that gives the highest return, given the mandate of risk parameter. And so if the investors are very willing to buy high negative yielding bonds, then possibly the rational mind is that might eventually turn out to be the highest return, risk return that the investor may find, especially more so we'll find that the equity market is experiencing double-digit negative decline during the period of last year. So, but counterintuitively, that should not persist for too long. It is inevitable that investors will push up to invest in other bonds as well. All right, so this is just a little bit of some preview. We have organized this. If there's any other question, could you just if there's any other questions, could you just ask along? Oh, okay, sorry. So Hilmi Azahar asked, can I briefly explain the impact of all these stimulus package to the capital markets? Now, of course, I think you're referring to the US stimulus package, the $2 trillion that's going to pump. Well, the details are still, it's still not outlined properly or properly announced, but I think into one part, the stimulus is more to consumer base, to encourage spending and also to cover something like, for example, the stimulus package for the UK is also to find wage compensation, as it is. So in that case, the capital market, the issue with capital market, of course, in the US is that they are mostly highly leveraged, and the fear that the default may trigger some contagion effect, especially from the shale producer. So therefore, the stimulus package may also find some kind of stimulus package to more or less to provide certain support for the shale operator, looking into the fact that the oil price have dropped below 25 to 30 per barrel at a certain time. Okay, Raj Kumar asked a question. Sorry, when the credit spread for energy-based high-yield bonds increase, does it impact the energy company itself? If the bond maturity is far away? I see. Okay, so Like for example, well, generally you can see that to answer your question itself, especially in Malaysia, maybe your question I'd like to put into the part whereby your question about the credit spread on high yield bonds, whether it impacts the company, right? Impacts the company. Of course, when you put the condition that the bond maturity is far away, you are mostly making reference to the product feature of the bond. Like for example, in Malaysia, very commonly these construction companies are issuing perpetual musyarakah. Therefore, the bonds are irredeemable, they're perpetual. And the coupons are non-cumulative. So in the event the issuers incur losses, they may have no legal obligation to service the coupon, and the coupon is non-cumulative, so it doesn't accrue to the next year. So as a result, the product feature will not easily allow the bonds to technically be in default, even though investors may not receive any coupon for the year. And for most of the bonds issued by the banking sector, all these tier capital bonds, and now they have this TLAC, total loss absorbing capacity, that some of these bonds may also suffer from credit risk. So we do notice that even the banking bonds, like Barclays, most of them have also dropped near to about 80 plus as well. So to a certain degree, the product feature may have to be analyzed. So this will be a bottom-up approach in doing some bond picking, especially now that we find that generally most bonds have just dropped to just about 80 to that point. Okay, so Nurul Amani asks, how will Malaysian bond be affected if it's no longer included in the FTSE Russell? Well, generally, most Malaysian PDS or credit papers will not be relatively affected, for it was not to be generally included as well. We are mostly referring to the MGS, the Malaysian government securities, or some of the select benchmark bonds as well. And possibly we do find that, of course, if the Malaysian bonds are not included in the FTSE Russell, this would be effect for those, in a way you can see that investors who are benchmarked to the FTSE Russell, and if the investors practice replication or indexing, therefore there is a very close, compelling reason to hold the bond because it's in the benchmark. But bonds have always duration replication, and this also finds that Malaysia at one time was a super 3. Our interest rates for the MGS were more than 3%. Very few countries that are investment grade sovereign rating more than 3%. So to one part that plays a more important role of the attractiveness of the Malaysian govies compared to also its inclusion into the benchmark, because most money managers and most managers are yield hunters. They are looking for yields, and it's a currency play more so than because the bond is in a benchmark. This is quite distinguishable from an equity index, which will find that the impact will be more immediate and the correlation will be swifter. That's it. Okay, anonymous attendee asks, does the Fed buying up corporate bonds mean credit risk has been transferred to the Fed? I wouldn't want to. I would say that the Fed buying up corporate bonds is not really something that what happens in this context is that okay, let me just run through okay, I just have something. Let's say, for example, just recently on the 8th today, one of the reasons to answer this is that because of the sudden drop in prices in both equity and bond market, we're looking into a drop about 20 to 30%, which was unprecedented, a 20% drop in the share market, Dow Jones, S&P 500, and also just now the bond prices, and that would trigger margin call. And we can find that this is a phenomena of a system-wide margin call. And so Federal Reserve plan is possibly to address this issue because this issue is immediate. And because of this margin call, there is a sudden surge for the demand in the US dollar, and the US dollar just went, and for the case of Malaysia, the US dollar just went, as you know, more than 4.4, 4.4. So all of this is part and parcel of that system-wide margin call. So I think Federal Reserve is more to address liquidity risk rather than to absorb the credit risk for the bond. I think this will be just not a very long-term policy. So therefore, this effect will not be where credit risk will be effectively transferred to the Fed, in my opinion. Yeah. It's more for the for addressing the liquidity for the demand for the US dollar. Okay, so anonymous attendee again said that he recently saw an article about the exclusion for the Russell and whether will this be a further damage to the bond. I think I've addressed that earlier on to one part. Well, we can say that for investors who are index hugging, for investors who are basically replicating the benchmark, then this would be quite a very pertinent issue. But more, but the thing about bond market has a wider spectrum for corporate demands as well, and also as opposed to insti investors who are looking for return. And also to a certain part, it's also a currency play. So as a result, I would consider that there would be some impact, but not the kind of impact that you will see in the equity space, in my opinion. Right, another question into how much ammunition do I think central bank has left in a fiscal set failed to deliver? Well, that would be quite. Well, I try to not just look at the statistics in mind, but try to play a bit of a black swan event. We do see that certain sectors in Malaysia are experiencing zero revenue events, and with the dollar hovering about near 4.4, that will definitely affect our trades balance of payments quite substantially. So I think I don't think I'm capable to give a very a much research idea or much simulated idea into it, but I would just feel that one should not refer on status quo when addressing that as well. Right, let me just try to look into some. I have some chat. All right, okay, so I think Shafika has mentioned that the Q&A has almost ended. So I think, yep, that's about the time. All participants, before you leave, it would be highly appreciated that this is a pilot run. We kept the session to be very short because we wouldn't know whether the response would be good or not, or whether participants feel that this will be a very useful session. If you find it useful, if you think that this is something CFA Malaysia can provide, or maybe you're here listening to bond market because just to kill your boredom being prison at home. Now that the imprisonment, the sentence will be extended till mid of April. So let us know if you like this format. Let us know what topic you want to bring. We'll try to bring far more distinguished speakers to be on board here to address most of the issue. We are also trying to come up with some, just for fun, right? Some competition, some Kahoot games, just to keep us all engaged, so that the society provides this service to you during this period itself. Is everybody all right, Karim? Yeah, thank you very much. So raise your hands. I think you can go there and raise your hands and to say that you understand, that you're still around. Thank you very much. So very good. And of course, Shafika, yep, you're there. And if anyone can just provide some feedback, that would be fantastic. Let us know, good or bad, what you like about the session, what you don't like about the session. Just give a feedback. Okay, so in that case, I will just end this session. Thank you very much for your time. Stay safe, and for some of you who are still going out there, be very careful.